Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today we're going to take a look at a brand new covered call ETF from a good friend of the channel and who's also sponsoring this video. And by the way, I'd like to thank Harvest for sponsoring this video. HPYM. This is the Harvest Premium Yield 7 to 10 year Treasury ETF. So this is the second ETF, covered call ETF rather, in their fixed income lineup. As you all know, they have HPYT or HYPT, the Harvest Premium Yield Treasury ETF as well, where they're also doing covered calls on US Treasuries. The main difference is really the duration. That is really the main and I would say only difference between HYPT and HPYM. So let's take a quick look at HPYM, guys, and then I have a special treat for you. We are actually going to talk to, first time on the channel, very exciting, Paul McDonald, the CIO, this Chief Investment Officer at Harvest ETFs. Mike Kovacs, the CEO, has been on a few times, but now we have the pleasure of also talking to the CIO, the brains behind, the investing strategy and the portfolio management, et cetera, et cetera. So HPYM, pretty new ETF, was just launched on January the 16th, so just a few weeks ago. They have declared their first distribution. You haven't seen it here. They declared it at 8 cents a share. So HPYM, I mean, it really is identical or very, very identical to HYPT. The only difference is the duration. So as we know, HYPT here, HPYT is long-term government bonds, right? With a duration of about 20 plus years. You see that here. But when it comes to HPYM, it's 7 to 10 years. So this is what you would call your midterm or intermediate duration bonds. What exactly does that mean? So when it comes to the strategy, let's cover that first, by the way. It's going to be the same thing as HYPT. They could do covered calls on up to 100% of the portfolio of the investment. If we look at the portfolio, it's very similar to HYPT, except instead of TLT in the long-term government bond ETFs, you have the medium term. So IEF is the prime position in this portfolio, and they write covered calls on the portfolio to generate really nice monthly income. So if you just open here, Why Invest, or if you click on product sheet, you'll get this page here. Same management fee as HYPT, same, it's still the US Treasuries, except it's medium term, just the duration is different. The cover call strategy is the same as well. They say up to 100%. Doesn't mean they're always writing up, 100% covered calls, but they do have a 75% baseline. So usually what that means is that they at least write approximately 75% covered calls on the portfolio, and they could adjust to the market for set distributions. And of course, Harvest, very, very known for those really nice, consistent distributions, right? So that is really the main difference. So, what is the duration? But what exactly does the duration mean if it has, there's less duration? Well, you have less risk, less volatility, which you could see in a really nice chart right here, which I'm going to show you. If you click on investor brochure, you'll be able to see the chart, but here it is. It's really cool. You have HYPT here, long duration bonds, and here's HPYM, the new ETF, medium duration, 7 to 10. And you see the blue line is the volatility, and the volatility here is much lower in the medium duration and almost non-existent or very, very low in the really short term, which is less than 3 months. And by the way, they did also come out with another fixed income ETF. This is not a covered call one, however. It's TBIL. We'll take a look at that one in a second, except this is really, TBIL is really, really short, less than 3 months on Canadian bonds, Canadian government bonds. So you can see here HPYM. I really like this comparison to HPYT. So more boring, less risk. So HPYM might be really nice for income investors, but more conservative income investors, in my opinion. There's going to be even less volatility than HPYT or HYPT, but the same very, very, very safe asset class, which is US government bonds. Another thing I want to mention, they launched .U versions of HYPT and also have a .U version of HPYM, which is interesting. So in case you for some reason you want to generate or get your distributions in US dollars instead of Canadian dollars, you could buy HPYM.U and now HYPT.U, which is very successful, over 200 million AUM in a short while here. So if you have US dollars, you could actually buy them with the .U versions. Very, very convenient. And like I was mentioned earlier, the first distribution was declared for HPYM. So you could calculate the yield yourself. It's 8 cents. If you do 8 cents times 12, you will get the annual distribution rate. And all you have to do is take the annual distribution rate divided by the market price times 100, and you will get the yield for yourself. But of course, it's actually very, very nice yield, but it's obviously going to be lower than HYPT because less risk, less volatility, especially if you're doing covered calls on something and there's less volatility, you're going to have less premium, right? You're getting less premium, but you're getting lower risk, lower volatility. And I was trying to find something, to maybe compare HPYM to, and there is MPay from Horizons. Horizons does have a midterm US Treasury ETF that's been out for 4 months. So we have 4 months of data. It's not that much, but you could see here it started in October 6th, started at $27, $27.19 approximately. Now it's at $27.40. So you could get a gauge or a sense of how boring or how, very, very low volatility this ETF could be. If we just compare it to HYPT, the long-term one, which obviously you have more yield and more volatility, it started at 1205 and now it's 1162. But remember, this is just a stock chart. You might be saying, "Oh, Adrian, 4 months or whatever, 5 months, and it's down 43 cents." When it first started, yeah, but HYPT also declared 4 distributions of 60 cents total, right? 4 distributions of 15 cents. So it would be really 1205 plus 60 cents, right? So it's actually, you would be up on it on HPYT right now if you include the income. Very important to include the income. But I just wanted to show you guys, HYPT, in my opinion, pretty boring and not that volatile. But in case you really want something, very conservative, very safe, and you're an income investor, now we have HPYM. And if you're asking, well, what's the comparison to MPay? MPay, you could buy it in Canadian dollars. The problem is they give out the distribution. Well, maybe it's not a problem, but just a fact to point out. You buy it in Canadian dollars, but you get the dividend in US dollars. So some of you might not like that, but HPYM, you could buy it in Canadian dollars and get the dividend in Canadian dollars. Or if you want to buy it in US dollars and get the dividend in US dollars as well, you have HPYM.U as well as HYPT.U as well. They also launched TBIL, by the way, the Harvest Canadian TBIL ETF. There's not much I could say about this. This is extremely safe, extremely boring. It's kind of like a cash alternative if you want to park cash. Extremely low, non-existent management fee of 0.1. But this is 0 to 3 month duration, and it's Canadian T-bills, which is extremely safe, extremely boring, kind of like a cash alternative. And you could check it out. You could read the documentation here. So could be good for an emergency fund, for example, something like that. But if you're an income investor, I do find HPYM is very, very interesting, especially if you're a conservative income investor. Really, really nice yield as you'll calculate yourself. If maybe HYPT is, you want less duration risk. So I think that's enough of me talking. I think that's all I have to say. What I really want to do is talk to Paul McDonald. We'll talk all about this new ETF as well as their fixed income. We'll talk about the covered call strategy. And so, yeah, let's talk to Paul. First time on the channel. Let's see what he has to say about these ETFs. All right, everyone, I'd like to introduce, first time on the channel, I'm super excited about this. We have the Chief Investment Officer, the CIO of Harvest ETFs, Paul McDonald. Paul, thanks so much for doing this. How's it going, my friend? Welcome to the channel for the first time. How are you?
I'm great. Thanks again for having me on.
Yeah, it's always good to have, in quotation, a big shot on the channel. CIO is pretty high up there. We've had obviously Michael Kovacs on many, many times. Great guy, met in person, and to talk about the funds. But you're actually the CIO, so you're really the brains behind, I would say, the investing strategy. Obviously, you have a team. I know you guys have a team at Harvest. So it's your first time on the channel. Tell me a little bit about Paul. Who is Paul? What kind of, what's your experience, your background? Give me the scoop, if you will.
Well, for sure, and thanks for putting me up on a pedestal out of the gate. Hopefully I can live up to that. Yeah, that's correct. I'm the CIO here at Harvest, and indeed I have a great team. I've got a team of 5 on the investment management side, including 4 portfolio managers, who arguably are the brains behind the operation. And so I've got 20 plus years in the investment industry. I have been with Harvest now 10 plus years. I co-cover healthcare as a primary active sector, along with one of our portfolio managers. And I also am very involved in the product development and, of course, a lot of the option strategies that we talk about. So that's a little bit of quick background, and happy to answer any questions on that.
For sure. Perfect. Thanks for that little intro there. Always cool to have the actual investment, the brains behind the ETFs and things like that. So I'm very excited to talk to you today. We're gonna focus more on the fixed income covered call ETFs, especially the newest one that just launched. I mean, you launched HPYM. That's the Harvest Premium Yield 7 to 10-year Treasury ETF. This is a covered call ETF, but just a few months ago, like 3, 4 months ago, you launched the the very successful, might I add, HPYT, the Harvest Premium Yield Treasury ETF. Same thing, but the duration is long duration instead of medium. Already passed 200 million in AUM, which for a new covered call ETF in Canada is extremely quick, extremely popular. So why don't we start with maybe give me the premise behind. We'll stick more with the medium term one because that's the new one. But overall, why did you guys decide? What's the premise behind these two, U.S. Treasury covered call ETFs? Tell me a little bit about that. Why you guys decided to launch them?
Sure. So maybe what I'll do, I'll take a quick step back, and
Yeah.
I know you're in Panama, so it's summer there all the time. But for those that remember summer of last year here, there was a lot of volatility in the market, and in particular in the fixed income market, we started to really see some what we would call dislocations. And so we've been in equities 20 plus years myself, and we can sense opportunity though, and we saw the interest rate environment as leading up to a potential opportunity, and so that started us doing some research in the U.S. in particular. Look, I'd like to take credit for the first covered call strategy on fixed income, but the reality is there is an ETF in the U.S. that gave us a little bit of insights into, okay, how do covered calls work within the fixed income market? But importantly, there's also an index in the U.S. that goes back 20 plus years, or around 20 years. And so that gives us some ability to look and say, hey, how do these covered calls work when we're looking at fixed income in different interest rate environments? And so that was sort of the premise behind us saying, hey, do you know what? We can do this from a Canadian's perspective. There's some benefits of having it in as a Canadian trust, but I actually allow Canadian investors to get exposure to longer dated treasury bonds in the US and generate that high cash flow. So that was the premise when we went back to last summer. We launched, we call it HPYT, so HPYT, back in the fall. And really the follow on to that is we've had a number of clients, investment advisors, individuals come in and say, hey, do you know what? We really like the idea of this, but I don't really want to take on duration. And perhaps we can talk a little bit about what that means. But it really was more inbound saying to us, hey, do you know what? We really want to have something that's more on the medium duration side. So hence we just recently launched HYPM or HPYM, both in a Canadian version and in a US dollar version as well.
Yeah, yeah. So for sure. So that was going to be my next question, right? HPYT, that's really the long term US treasuries, but you launched the medium term. What would you say would be the biggest, obviously the duration, but what exactly does that mean? Obviously I know it's less volatility, less risk, but if you could give us more details, because I'm definitely not a fixed income expert or bond expert, what would you say would be the main difference or the risk difference between the two ETFs?
Yeah, great question. And so maybe what I'll do is I'll get a little bit technical here on
Please.
two things. The first one, something called implied volatility, and then the second one is duration. And so when we look at bonds, first of all, there's no options on bonds per se. So hence we get the exposure by owning underlying ETFs that own the bonds, and then there's options writing on the underlying ETFs. And
Okay.
so implied volatility though is something that is, without getting too complicated, it's basically what the market's expected volatility is going to be. And so we look at implied volatility across our equity income mandates and the fixed income mandates. And so the reason why implied volatility is so important is because it is the fundamental most important contributor to an options value.
Right.
So
The
if the
premium.
market is at the premium, that's right. And so if we think about in the equity world, in and around earnings reports, the stock may be flat, but we see implied volatility being high on the stock, meaning we're getting more premium. And so that is relevant for the conversation on fixed income, because duration is a metric that we use to measure what the expected volatility effectively is going to be of a bond or a bond fund. So again, there's a number of data sets that go into the calculation, but in its shortest, simplest way, to explain it is the duration measures how much you would expect the bonds to move if you were to have 100 basis points or a 1% move in interest rates. And I will ostracize that and say that does not mean the federal funds rate. That means if I'm buying a 10-year bond, the move for the 10-year yield, if it moves by 100 basis points, how much would my bond price expected to move? And so again, when I put those two items together, being implied volatility
Yeah.
and duration, the more you go out in maturity, the higher your duration, the more sensitivity you have to bond prices. And so somebody I know it's a little bit of the Home Alone mode where you know 15 cents a month. You know, yes, it's a big amount of cash flow, but that's driven this on HPYT. That is driven by the fact that we have higher duration and therefore higher expected volatility and therefore higher premiums. And so as we move to shorter durations, being 7 to 10 years, as one would expect, you're not going to get the same type of expected moves. You're not going to have the same type of sensitivity to interest rates. But the quid pro quo to that is you're not going to get as much in premium. So from a risk return perspective, one would expect or should expect that having lower duration, you would expect less volatility. But the flip side is you're getting less cash flow from your option premium.
Yeah, yeah. I typically like to put risk and volatility. I kind of see them almost as the same thing. So less duration, less implied volatility, less risk. So maybe another way I could ask you, why would someone choose HPYM over HPYT or HPYT, like you say, which actually a good way to say it because it's like one of the stock symbols I keep messing up all the time. HYPT, anyway, HPYT, so much easier.
HPYT.
Yeah. Why would
Yeah,
someone choose the medium over the long or even vice versa? You know,
so great question, and it's loaded with all kinds of reasons. Ultimately, if somebody's looking at the shorter duration, they're looking at lower volatility,
yeah,
perhaps a smoother ride, and a little bit lower cash flow. Now, portfolio construction, I know we've had to have portfolio managers that also own our fund. They're looking at targeting very specific durations. They've got a particular viewpoint on where they think interest rates at that part of the curve are going to go, and therefore are targeting that part of their portfolio. But generally, it would be somebody that is okay taking on duration or taking on that expected volatility at the longer end and has a need or desire for those high cash flows. They would be looking at the longer duration. Now, somebody that perhaps wants a little bit smoother ride, recognizing you give up some of that cash flow, would likely look at a HPYM.
yeah. I love that smoother ride. I think I'm going to use that. That's actually pretty good. And it makes sense, right? If obviously if you're going to get something with lower volatility with a smoother ride, you could expect less option premium, less cash flow. So yeah, that makes complete sense. But either way, they're both investing in really safe asset classes. This is really boring stuff. US Treasuries, right? So really it's a smoother ride, but either way, the assets inside both of these are quite, safe, A plus or whatever that rating is. So next thing I want to ask you about is obviously this channel is all about income, right? Cover calls is our bread and butter, just like it is for you guys. So I want to talk about the cover call strategy or the option strategy. Very unique. I have to admit, I would say I was pleasantly surprised that Harvest adapted because you guys do have competition in this space now in Canada, but you guys are the only one that adopted a higher percentage of coverage when it comes to the options, right? So on your equities side, on your HHL and all those great ETFs, you guys you cap it at 33%. You don't write cover calls more than on a third of the portfolio. But for these two fixed income, and you could see this in the fact sheet, by the way, it's 75%. That's kind of like a baseline coverage. But right there on the homepage, you could go up to 100%. So this is a far cry from your equity cover call strategy. Why did you guys decide to do that, to write like so much higher covered calls on these compared to the equity ones?
Well, I guess I would start out and say track records matter and experience matters. And so when I look at our experience with what we have, coming into 10 years on HHL, for example, same distribution paid every month. HTA has increased its distribution a number of times.
Yeah.
When we look at our equity income strategies, we're in areas of the market that we want to be there. We like the structural dynamics of these areas. And so we always want to have that long bias to the upside, that long-term growth as companies are reinvesting and growing their cash flows and growing their businesses. And yes, we will forego some of the upside in favor of current cash flow.
Yeah.
Now, when we think about fixed income, we're thinking about fixed income, and we want the income from our fixed income. And so when I say those track records and experience, when we look back at the 100% write-in ETF that's in the US, we said, okay, do you know what? We don't want to pay out a variable amount and be writing every month 100%, but we do want to be able to be paying high relative cash flow. And so we've generally been writing between 50 and 75%. Volatility in particular late last year was up, so therefore our write levels commensurately come down when that happens. And so it's a very valid question. We're 33% on our equities. We want to be there for long-term growth. In our fixed income, we really want to be there predominantly for the income. Yes, we're unwritten on a little bit. Yes, we've got a little bit of writing out of the money, so we'll participate as the long run rates do come down, or if they come down further, we will get some of the participation. But generally, we want that big cash flow from our fixed income sleeve of our portfolio.
Hey, the argument makes sense. On the equities, they tend to go up very quickly over time, but fixed income doesn't really work that way. So it makes, it's a lot slower. But what would you say to people who are worried because, and the ETF you were referring to in the US is TLTW, I'm pretty sure.
That's right.
What would you say to people who are worried that with such a high coverage ratio, and I'm glad you actually mentioned the moneyness, you said out of the money. So even if it's 75%, if it's out of the money, you're not just capturing 25%. That would be if you're doing 75% at the money, but you're doing out of the money. So what would you say to people who are like, well, listen, bonds are fixed, the interest rates are high. When they get cut, bonds are going to go up. So aren't you giving up too much upside if you're writing on such a high percentage of the portfolio? I know you guys have an active approach when it comes to covered calls. So what would you respond to people who, have that worry where interest rate gets cut? I won't capture that much upside with these ETFs.
Yeah, good question. So a couple things on that. One would be, I would just touch on what does it mean when interest rates get cut? And when I think of the longer end of the curve, like I was saying, a bond's duration is generally the sensitivity to movements of that part of the yield curve. So we could end up in a scenario where interest rates, air quote, being the Federal Reserve or the Bank of Canada, the central banks, are cutting interest rates, but that does not necessarily mean that your bond prices will go up. And in fact, if you look at what's happened in the 10-year yield as of late, the rate has actually gone down by almost 100 basis points at the long end of the curve already. So if you look at kind of 5 down to about 4%, and so again, if somebody is looking for targeting and being more tactical in and around making some sort of interest rate call or interest rate, I wouldn't call it speculation, a valid interest rate view, then they can perhaps go into shorter duration or longer duration with covered calls, and they have that option, and investor choice is very much important. So there are lower right funds, there's no right funds, and of course, from our perspective, we want to be generating that relatively high cash flow every month. So when I think about somebody that's worried about giving up upside, I guess in part you've had that happen already at the longer end of the curve, and the fact that we're still getting some of that upside is very important. But I do think that people, looking at our product are looking at it for that relatively high cash flow. I'd put a little asterisk in there too. We've gone through, like I said, that data set that we had, we were able to look back to the early 2000s with covered calls to say, hey, how does this work in different interest rate environments? It's really important that there's a couple of areas that generally we see covered calls outperforming. So if we think about slow declining rates, if longer end rates go down really slow, we'll get that little bit of 1 to 2% out of the money plus our unwritten portion,
Right.
And the cash flow. So you would expect in that environment to outperform. Rates go up aggressively, which we just went through. You would expect a relative outperformance there. Sure. But there is an asterisk though that I think everybody should be aware. If you're looking for that inverse correlated insurance for an environment like what we went through in 2008, where long end rates drop by 200 basis points in a month's period, you're not going to get that big surge in price. And so, those that are looking at our fund are really looking more from a cash flow with a little bit of upside.
Yeah, that's definitely my personal priority, and most of the priority on the viewers of my channel is maximizing cash flow. So, and yeah, to your point, right, you have a good point. I doubt Powell is going to say, okay, we're cutting interest rates by 100 basis points. They'll probably go by 25 a shot, which is very small, very gradual, which is good for these strategies, I would say. So last question regarding these ones. So I know Harvest is really known and popular for their consistent very, very smooth and consistent monthly distributions. So you chose, HPYT, it's 15 cents. HPYM at the time we're filming this, I think it was declared, but it's not on the
Yep.
website. Either way, by the time this video comes out, I'm sure the first distributions are going to be declared. So you guys are known for having very smooth, consistent distributions. And I've spoken to Michael about this stuff before. You guys do a lot of back testing before you launch something. So my question for you is, how confident are you to sustain these initial distribution rates for these two ETFs? You see at one point, let's say maybe if volatility drops like a brick, you would have to maybe modify them, or do you think you have a comfortable some room to maneuver?
Yeah, a very valid question, and talks to a little bit about our sustainability analytics. So every quarter, at the start of a fund, we conduct the same analytics, but every quarter we also go through and basically assess, hey, are we meeting the objectives of hitting our cash flow, and can we do this going forward? And so I think that's a little bit different than perhaps others that maybe aren't doing sustainability analytics. And so we do that for each one of our funds. We're quite confident with our fixed income lineup. Having that flexibility to go up to 100% does allow us to have that confidence in the distribution. And so for clarity, some of the other things that we looked at when we said, in particular HPYT, given it's
Yeah.
relatively a fairly high monthly hurdle rate at 15 cents per unit, we went back to '06 and said, okay, if volatility were to compress to the low levels, can we still sustain the distribution writing 100% of the money? And the answer to that is yes. So that's how we came up with our initial distribution. Now, if rates gap higher, fund goes lower, and volatility compresses, then that's your outside risk. Now, rates gapping up and units going and bond prices going lower wouldn't be an environment in which we would think volatility would go down, but that's where the risk would come into play on the distribution sustainability. But for now, and from the historical back testing that we've done on distribution sustainability and that we do every quarter, we're very confident in the distributions right now.
Yeah, that's what I like to hear from my options managers for sure, hearing that
Yeah,
kind of stuff. So I mean, Harvest is known for that consistency and
yeah,
giving some room. So last question on these two, and then I'll move on quickly to T-bill. I saw
sure.
that for both of them, you launched .u versions. So HappyT.u, HPYM.u. So that means you could buy. They're still listed on the Canadian market, but you could buy them in USD and you get your distributions in USD. Why did you guys decide to actually launch .u version of these two?
So really inbound interest from end investors and from
Okay.
advisors looking to actually have US dollar in and US dollar, pay in US dollar and out. But there are some benefits being a Canadian trust. There's some benefits on relative taxation to it being a US domiciled ETF, if you will. So really it came down to, we've had a number of inbound interests we want the US dollar exposure.
Okay. Yeah. I mean, it's always good to have options for sure. I like
That's right.
options. And just moving on, I'll share my screen real quick. T-bill. So this is your other fixed income, very, very recent, the Harvest Canadian T-bill ETF. So like the name says, this is going to invest in the Canadian T-bills or bonds. Very, very, very low management fee, very, very low risk, obviously. My question is, how come you're not doing covered calls on this one? This is just a pure T-bill ETF. I'm just curious. You're doing covered calls on the other ones, but this one, no covered calls. What's the idea behind T-bill?
Well, maybe I'll kind of bundle up a little bit of extra info too, just on some of the landscape that's out there. And I would say,
Yeah.
I've seen some shorter duration, like very short duration, covered call strategies. But when you peel back the layer, they're really investing in cash and 20-year bonds. And so,
Okay.
from a more sophisticated perspective, you end up taking on what we'd call a different type of yield curve risk. From our perspective, once you go sub 5 years in the bond world, your implied volatility really drops down to next to nothing. And so there's really no incentive to be writing covered calls. And in fact, once you go
Okay.
less than a year, there's no options available. So for us, T-bill, we have cash management within our own funds, and we recognize, hey, do you know what? Here's an opportunity for us, a one-ticket solution. Anybody that's looking for cash management, 0 to 3 month Canadian T-bills. I don't want to oversimplify it. I think we've got a great symbol, but it's at T-bill, but it really is at 10 basis points. It's a cash alternative for those that are looking to perhaps have something outside of their bank account or outside of some of the HISs that are undergoing some changes right now. So 0 to 3 month Canadian Treasury bills.
Yeah, I saw 0.11 weighted maturity. Yeah, 0 to 3 month, that's almost like no volatility. So it makes sense.
That's right.
You to cover call premiums comes from volatility. If there is none, you barely, it's not even worth it. So
It's not worth it. Yeah.
that was the other question I was going to ask you is, you think this is a good cash alternative? And you answered that. So the answer is yes, very, very, very low risk and monthly distributions as well on T-bill, right? So this is cool if someone is still wants something really, really low risk cash alternative, you could actually get a monthly distribution on T-bill, right?
That's right. I'll just on taxation wise, typically that is taxed as income versus
Regular
within our
income, yeah.
regular income versus the covered call strategies are generally expected to be a component of capital gains with some small foreign income as well. Now I'll ostracize that with there's a lot of moving parts and within the taxation of funds, but generally still very tax efficient.
Yeah, I think my opinion is not. It's very well known about these types of investments. I would all rather go with something like an HPYM personally, if you want something safe. Although it's not as safe as T-bill for sure, but
Hmm.
I consider it relatively consistent and stable. I think it's a great alternative. I'm assuming the yield is going to be a lot higher than T-bill, but we'll find out when the first distribution gets declared officially at the end of February. So. Paul, I think you answered all our questions when it comes to fixed income. I would love to have you back again to talk more about the equity stuff, which you guys are
Hmm.
have been in around for a long time. I know HHL, your number one covered call ETF in terms of AUM, which by the way, congrats, just passed 1.5 billion,
Hmm.
humongous in Canada, is celebrating its 10-year anniversary, I believe, at the end of this year. So hopefully we could have a nice discussion about that because it is one of our favorites, right? And obviously it's an HDIF in the all-in-one. So hopefully you'll be back.
Yep.
So
I'll look
thanks for
forward to
coming
it.
on. It was nice having you, and see you again soon.
Likewise. Thanks again.
Take care. Bye bye.
Bye bye.